Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, so we should be ready to start things off. Thanks, everyone, for joining us this afternoon. Today's session will be hosted by Mark Sebastian, who will be teaching us about analyzing realized volatility. Mark Sebastian is a former market maker on both the CBOE and the American Stock Exchange. Along with his role directing the path of education for Option Pit, he also trades privately. He started the popular blog Option 911, I should say, which is now the Option Pit blog.
Option 911, by the way.
All right.
That.
Fair enough.
I was angry. People are like, oh, is that Option 911? I'd be like, really? You think I named my blog after the greatest American tragedy of the last 50 years?
Yeah,
no,
I would expect a little bit more tact, I think.
All
right, so we're just going to go ahead and turn it over to you, Mark.
All right. So how's everybody doing today?
Everyone's doing great.
Oh, wonderful. How are you doing today, Katrina? It's good to hear from you.
I'm doing fine. Thanks, Mark.
All right. Let me get my, I've been running around like a headless person today. You don't have the slides loaded up?
They are actually up right now, yep.
I see them. Gotcha. All right. Cool. So today we're going to talk about analyzing realized volatility. And you're saying, what the heck does that mean? Well, you'd be surprised. A lot of people don't realize realized volatility is just another fun term for historical volatility. But in today's webinar, how do I move the next, oh, here we go, sorry. In today's webinar, we're going to discuss the different types of volatility. We're going to talk about the nature of volatility. We're going to talk about ways to calculate historical or realized volatility, talk about its uses, and then we're going to talk about a couple of directional bets. I forgot that you have to call in today, and my apartment gets really bad cell phone reception. So I'm actually at 75 degrees here in Chicago, and so I'm actually sitting out front of my my condominium in a little grassy knoll area. So if you hear some background noise, that's what that is. And there are worse things than giving a webinar in. There are worse things than giving a webinar in. This kind of weather. So I'm relatively pleased about it. So, all right. So let's keep going. What is volatility? Volatility is movement in an underlying, regardless of direction, measured on an annualized basis, expressed as a percentage. All right? Many people don't realize that, but in statistical terms, volatility is just a cool trader term for the word variance. And many of you may remember from stats class, as it was kind of the big thing to talk about. Oh, variance this, variance that. The volatilities we see for a given month in options is actually an annualized number. So when you're looking at whatever brokerage platform you use, Options Express, Trade King, Thinkorswim, Trade Monster, who cares? You're actually looking at an annualized number. The volatility is 38%. That is an annualized basis. All right? In fact, all volatility is expressed on an annualized basis. So if we're talking vol, we're talking in an annualized way. Okay? All right, example. All right, here's a couple of examples. All right? On underlying trading, $80 has a range of $22 during a given year. The stock moved 22 over 80. That's 27.5% vol. Okay? The move could be $22 up, down, or up and down. Any of that would be volatility. Any of that would be at 27.5% volatility. All right? If the next year the stock moves $20, the volatility was 25%. If the next year the stock moves $21, the volatility would be 26.25%. Now, why did I use all of these different vols, but keep them somewhat close to each other? Well, reversion, all right, mean reversion. In any given year, an event can cause a stock or index to have an outlier volatility, but over time, volatility of a stock or index or ETF will tend to mean revert. This means it will hover around an average. This applies to all types of volatility that can be measured. All right, they all tend to mean revert. I mean, you would be shocked, but you know, over time they hover. Okay. So types of volatility. There are three main types of volatility traders watch. Option traders, that is. All right. Historical or realized volatility, implied volatility, and forward volatility. Now, you can get into debates about historical implied volatility and historical forward volatility and different things like that. But, you know, I'm going to put those all under implied volatility. Okay? So I'm going to put any historical implied volatility under implied volatility, any historical forward volatility under realized vol. We're going to lump them into three big classes. Okay? Historical, implied, and forward. Forward volatility, sometimes called future volatility. This is how much a stock will move going forward over a period of time. So, you know, you see school buses, and I wonder why anyone would ever let their kid get in one of those things. It looks like, you know, it's like it's as sturdy as a house of straws that moves, and with a driver that's probably driving too fast and or poorly qualified. Just throwing it out there. Okay? So someone's saying vol is an output of a model formula. When the bid-ask widens on the weekend, this caused vol to be not so accurate for out-of-the-money strikes on weekends and after hours. Great question. I'll answer that later. Okay? And not all vol, the one thing I would say is not all volatility is an output of a model. All right? Not all of it is. Okay, that's implied vol that is an output of a model. Historical vol is a input, you know, is basically an input, and forward volatility is just everybody's guess, you know. So sometimes called future volatility, it's how much a stock will move going forward over a period of time. This is, you know, the veritable golden goose. You know, you wonder, you know, it's basically what we're all trying to trade. All right, if we knew forward volatility, options would be perfectly priced. There would literally be nothing to trade. They would be priced like auto insurance and things like that, where, you know, you run your little actuarial model and you kick it out. All right? So, you know, it's kind of an interesting thing. So if it wasn't for the fact that we didn't know forward volatility, we wouldn't have anything to trade. So it's, yeah, I'm not putting my kid on a school bus. Just saw another one go by. Anyway, so this is why we trade. You know, well, maybe especially in the city of Chicago. Let me put that out there. So if it wasn't for us not knowing forward volatility, there would be nothing for us to trade, nothing for us to potentially profit off of. So it's a good thing we don't know forward volatility. Okay? Now, then you've got implied volatility. Implied volatility is what the market is betting forward volatility will be over the life of an options contract. Okay? This vol is found via price discovery. Okay? So this is an output of a pricing model. It is not an input. Right? This actually, the fact that implied vol is an output is something that completely throws people off all of the time. You know, that's why I'll have students come up to me and they'll be like, Mark, my Greek said this, and then this happened, and then now I'm down this. I don't understand it. Well, you're dealing with a model that is based on an output. And so when the input of a model can be changed, then then you're dealing with Greeks that can change. All right. So now we get on to historical volatility. The movement in a stock or option, all right, over a given period of time in the past, all right, there are all kinds of different ways of measuring historical volatility. But the thing you've got to remember is this is a backward looking, all right? It is a percentage that is backward looking. You've got 10-day, you've got 20-day, 30-day historical vol. Then you've got 5 and 10-year averages, okay? I knew guys that would pull up 5-year and 10-year averages on the floor and use that as part of their strategic planning for their position. You know, especially when vols were getting really high, they would look and say, oh, wow, this stuff's getting really high. When was the last time it got this? When was the last time, when, if ever, has this ever moved this much? So, you know, the basic thing, though, is traders are arguing all the time over how many days out should you measure, okay? How many, and what kind of vol should we use? You know, there are different ways of calculating historical volatility. All right. So, yes, there will be a link to this class, and I'm sorry that you're leaving because this is going to be just chock full of awesome info. So we're going to talk about, all right, how do you calculate historical volatility, and, you know, what should you do? So the first thing is days. All right. The more days one uses to analyze historical volatility, the less noise the calculation will have. However, the trader loses some level of granularity. All right. Small periods of time that can, they'll lose small periods of time that can cause a stock to go haywire are often lost during periods greater than 30 days. All right. However, traders need to know long-term means, so overall knowledge of long-term HV is important. That's exactly what I'm saying is, you know, when I'm looking at vol, we're going to talk about this, is I care about the short term, the short intermediate term, and then the way, way long term. I think a lot of that intermediate stuff is kind of useless. All right, I'll get into that. Days, all right. I look at two major historical vols, or realized vols. I look at 10-day and 30-day historical volatility. I also like to look at long-term historical volatility, 5 years or so. So I'll pull up, if I'm looking at Apple, I don't know if you guys know this, but on several occasions I've traded Apple straddle somewhat successfully. And on each of those occasions, it's been, well, the historical vol has been near 5-year lows, and 10-day and 30-day has been super cheap. And then we've added that to a really, really low implied vol. All right? But anything in between the two, in between 30 and 5 years, I mean, there's not a lot there that's really worth looking at. I've never really been able to find a use for 60-day historical or even 120-day historical. They just don't do anything for me. So I don't know. I just don't use them. Okay? So then the next part is calculating. So most analysis is done open, or close to close. So in that calculation, you would use, they would take the end of the day or opening prices. So really what you'd be dealing with is, okay, the SPX closed up 18 handles today. Yesterday it closed down or up 0.85. The day before it closed down 18 handles. The day before down 4 handles. The day before up 30. And it would literally be the net change on the day is what they're calculating for that historical volatility. Okay? Now, I think that's a fine way to look at HV. Okay? It's not my favorite. okay? Because they miss some of the intraday movement. Anybody ever traded in a trading day where, the market opened up $18 and then closed unchanged, or closed down $10? So, yeah, well, the interesting thing is that, a lot of yeses, the interesting thing is that close vol and open vol misses a lot of that information. Okay? So the types I like, all right, the two types of IV I like are high-low implied volatility, and I like range volatility. All right? And I do look at close. That's kind of the actively put out there one, so I obviously am looking at that. But I really like high-low and range volatility. All right, high-low. All right, this is the difference between top price a stock or index traded versus the bottom price a stock or index traded over a specified period of time. It gives insight into how much the underlying really moved over a given period of time. It actually gives a lot of insight. Part of the reason why I like it so much. All right. So then range vol is the average daily range for a stock or index over a given period of time. So, I like to say that gives us an idea of how much the Bronco is bucking. So if so if we were going to, let me pull up the whiteboard real quick. Nope, not what I'm looking for. Here we go. So if I pull up the whiteboard, if we had the SPX high of over the last 10 days was 1345. I could probably make that smaller. Let me see if I can get that. Yeah, there you go. Was 1345. I believe the low was 1264. Does that ring a bell with everybody? All right. That would be a total of 79 points of movement. This is high-low. All right. So that'd be 79 points of movement. And, if we said our average price over that 10 days was 1,300, I would probably use like a volume-weighted average or something like that. All right. Our average price was 1,300. We would do the square root of 10, if I was doing 10 days, over 252. You're saying, Mark, where do you get 252? All right, well, there are 365 days in a year. There are 104 days that are the weekend, okay? And then there are 9 trading days in which we're not trading. That puts us, because those are our days off, okay? So that puts us at about 252 days, sometimes 253, times, all right, 1,300, all right, times, and then our HV is our kind of X variable. And then, the 79 points would be our output. So real quickly, what does that equate to? What is that vol, guys? First one to get an answer, I'll buy a Mai Tai. Come on, out with it. If I beat you, nobody's getting a Mai Tai. Let's see, this is 258. No, that's wrong. 258 times HV equals 79. So what's 79 divided by 258? Or 259 really? Yeah, you can evolve about 30%. So, folks, we had a nice little move over the last few days.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.